Good afternoon, folks. How are things going? Just wanted to talk about Sofi for the most part today. Wanted to start off with their Q1 2023 results. I wanted to review those live with you guys. Of course, I have reviewed these a little bit this morning. Plus, I listened to most of the conference call. I don't really enjoy a lot of the Q&A, mostly because they tend to talk to guys who are just working for some of the large firms. They never ask questions of people who are just regular investors like us. So I'm happy to answer questions you guys might have. But remember, I am not on the SoFi team. I'm just an investor. And but look, the stock absolutely cratered after earnings, and I have an explanation for that, and we'll talk about that. But let's talk real briefly just about the earnings themselves before we dive into particulars. Number one, they beat expectations. I had a sort of best case optimistic estimate of earnings through my Patreon group that I made through Discord. I was gonna try and let that slide and hope that no one noticed that, but I actually brought that back up. So my earnings that I put together was not realized, and I was I was off the mark there. But all of the analysts were off the mark also. I think consensus earnings was minus 8 cents per share loss was consensus earnings, and they actually came in at minus 5 cents per share. So they beat earnings fairly handily, and their results look pretty good across the board, with the exception of Galileo, which hasn't made the huge impact on earnings yet that we expect them to make in the future. And we don't have a great explanation right now as far as why Galileo's earnings are down. But I do have some ideas on that. But apart from that, the earnings look absolutely incredible. And last quarter in fourth quarter of 2022, earnings looked great as well. So why is the stock down? The stock is probably down for this reason and this reason alone. Guidance was increased, but the increase in guidance was fairly weak, which means that they didn't take into account the sort of blockbuster earnings that they had in 2022. The momentum they carried forward in 2023 in Q1. That really wasn't accounted for in a meaningful way, meaning they absolutely beat the pants off of earnings, but they didn't really raise their guidance, which suggests to me that they are worried about troubles in the future. And I think that's a reasonable expectation for the banking industry in general and for the economy in general, that we're going to face some macroeconomic headwinds. And I think the weak guidance, meaning they didn't reduce what they expect in terms of earnings going forward. They actually increased that in terms of what their revenue estimates were. And I think that the market, though, really expected them to raise guidance even more. I will say one thing: SoFi's guidance has always been traditionally very, very conservative. It didn't seem that way at first when I first started following the company. It seemed like their growth numbers were kind of ridiculous going forward when I looked at them just as a student loan provider. Since that time period, though, they've greatly, greatly diversified their revenue streams. And that's really the story here: is they beat on revenues, and it's mostly because of their diversified revenue streams here. They also increased their deposit base. They vastly decreased their cost of funding new loans because of their increased deposit base. They increased their cash position on their balance sheet. I'm not talking about the amount of deposits they have in their bank. What I'm talking about is the cash that they have on their balance sheet themselves. And they increased their net interest margin year over year by a massive amount. So why is the stock down? I'm saying that it's probably due to profit taking. The stock has been up a little bit in the last couple of weeks, but it's mostly been all about the weak increase in guidance that they projected. So let's dive into some of the numbers here. The increase in members, they're up 46% year over year, up to about 5,656,000 members, which is great. But the increase in members doesn't necessarily tell you everything you need to know about what's going on in the business. One of the most important things that I got from the actual webcast was the more than doubling of average revenue per product for the client over the last 2 years, meaning that the relationships that they've established with their clients are becoming more profitable. They're generating more income off of those members and generating more income per product. as they're cross-selling across their many lines of business. So in terms of total products, they're up 46% year over year, and it's roughly 8,554,000 products. In terms of Galileo accounts, this is the one downside here. We saw about a loss of about 5 million Galileo accounts. They didn't dive deeply at all into this during the presentation, so I don't really have an explanation for that. They did mention the fact that they signed one large new client with Technisys in Mexico, and they also stated that they're shifting their focus from smaller clients with Galileo and Technisys to larger, more institutional clients. I look forward to seeing growth on the technology front here, which is Galileo, Technisys, Sofi, all put together in a single online platform. Believe it or not, I've started working with another company here pretty soon, and I am looking at integrating possibly a Galileo solution for the software packages that I'm working on right now. And that's going to do, eventually that's going to do with a loan package that we will be putting together for folks that are using our software system. And so I'll be definitely keeping track of this. And Galileo actually provides a solution for us that's going to integrate really well with our software package once it's ready to go, once it reaches that point. So lending and financial services products. So of course, lending products year over year up 24% to 1.4 million. That's actually a surprise when you look at the fact that student loan volume is down something like 70%. Home loans are down something like 20% off of that mark, or 70% also off of that mark. But financial products are up 51% year over year to 7.1 million. So this is kind of the real story here, is that we're looking at the ratio of financial services to lending products increasing year over year from 2.4 to 1 in Q1 of 2021 to double that, or roughly double that in Q1 of 2022. And we see an increase to 5 to 1 in Q1 of 2023. I don't recall from any past things that I've read or listened to about Sofi what their ultimate goal is in terms of this ratio. I'll dig more into that and try and find out more about that later. But we are looking at healthy growth across the board here, except in terms of Galileo products, like I said, and we'll want to watch that going forward. Okay. So in terms of the financial review, the quarterly adjusted net revenue was right at about $460 million for Q1 of 2023. That represents a sequential increase over Q4 of 2022. And the quarterly adjusted EBITDA is up to $76 per share. So EBITDA can be described in a variety of different ways. The folks over at Berkshire Hathaway describe it as BS. I don't think it's the best measure of determining whether or not your company is approaching profitability, but it's not a bad way to look at things. So, okay. So net revenue was 460 million versus guidance of 430 to 440 million dollars. So they generated a healthy $20 million more than their guidance, beating at $20 million over the high end. So if they had come between 430 and 440 million dollars in terms of revenues, we would be saying that they met expectations. EBITDA was 76 million versus guidance of 40 to 45 million, which represents a $31 million beat at the high end. And that is huge. That mostly has to do with increasing efficiencies in terms of their margin, their product margin with their lending products, and their net income margin, net interest margin over their entire operations. So, so their non-GAAP guidance adjusted revenue Q2 2023 low, they're estimating between 470 and 480 for the high. They were pretty close to 460 they were right at 460 for this quarter. So I don't think that that's unreasonable, and that's right in line with their estimations of year over year growth of between 25 and 30%. It's a little bit higher than that. But yeah, everything looks good, and yet the stock actually crashed by something like 12% as far as what I'm looking at right now. Let me see. Wow. Be like Buffett and buy addictive products. Well, Edward, it is a good business model. He used to own a lot of tobacco. I don't know if he still does or not. But when you're talking about addictive products, he owns a lot of oil. But a lot of oil in the sort of pipeline midstream sort of area as well. Not as much in the exploration realm. And but he owns a lot of like refiners, pipeliners, that sort of thing. He owns Coca-Cola, which definitely qualifies as an addictive product. But take a look at what he owns in his portfolio. And boring as it might seem, the man has some absolutely outstanding track record when it comes to investing over time. And he beats out a lot of technology investors. When you look at the average return in his portfolio over the last 40 years or so, it's absolutely amazing. And Sheila's Joe, you're right, Coca-Cola. This is not so Warren Buffett does have investments in fintechs, but most of the investments that he has in fintechs are in emerging economies, which to a degree seems counterintuitive when you look at his strategy of being a value investor. The Berkshire Hathaway has expanded outside of that value investor range for the time being, or in recent times. But worryingly, one of his largest investments in fintech is in Latin America, and it's with Nubank, which used to be a client of Technisys, but they went ahead and developed the full stack of their own. And now they are a competitor, not necessarily a competitor to Technisys, but they provide a rival technology that they're using themselves. I don't know if Nubank is actually licensing that out to fintechs like Technisys is. So I would look at them conservatively as being a competitor to Technisys to some degree, which is not encouraging in a lot of ways when it comes to SoFi's business. SoFi, one of the things we should be paying attention to that we're not as SoFi investors is the addressable market that they have outside of the United States. And in particular, I'm looking at Latin America. I think that SoFi is probably just getting started in terms of its expansion in Latin America. We are starting to see some business being done in Brazil, some business being done in Mexico, and most of that is, let me see here. Edward Gilmartin says Coke and McDonald's outperform everything since 1985. HSY2. That's true. And to be honest with you, I don't understand how McDonald's outperforms everything. I have not eaten at McDonald's and I don't know how long. And I just don't hang out with people who do eat at McDonald's. But they are a popular company abroad as well as in the United States, and they show relatively consistent growth, just like Coca-Cola does. But Coca-Cola sells a lot of products besides just Coke, like they originally sold. So they're a diversified business as well. They're just concentrated in beverages and snacks. Back to SoFi though, for a moment though, there was nothing at all negative in this round of results from them. You could say that the Galileo losing about 5 million accounts was negative. I think a lot of that probably had to do with macro headwinds, and like they said in the live stream that they had earlier, that some of that has to do with their change in focus when it comes to who they're concentrating on as far as getting clients through the door. So yeah. Joseph Purvis says L. Not sure what that means. Okay. Feel free to expand on that comment, Joseph. But yeah. So do you guys have any questions about what I went through when it comes to SoFi's earnings at this point? If not, I can move on and we can start talking about some other things in banking. And I think that the big news is going to be First Republic stock investors are facing a wipeout. Guys, this is what happens. What's basically happening is that First Republic assets are being separated into a good bank and a bad bank, right? So JP Morgan is essentially going to buy all of the good assets from the bank, bailing them out, keeping their operations afloat, keeping their, basically their branches open. Eventually, those are going to become JP Morgan. Well, possibly they'll become JP Morgan branches. But what's going to happen with them is there's going to be a separate bad bank, and that's what the investors are going to get. It's going to be liquidated for just about nothing. So common shareholders are not expected to be made whole. They are going to absolutely take this in the shorts. And that is the way stock works. If you're a common stock holder, you are at the back of the line when it comes to recovering anything during a bankruptcy. If you're a bondholder, ostensibly you're supposed to be at the front of the line, right behind general creditors and employees, but that is likely what is going to happen. So let me see here. Martin says invest for obese folks, SKX and Crocs. Something interesting. See here, something interesting that I learned over the weekend is that Crocs have a more illustrious history than we ever believed. And do you guys remember the movie Idiocracy? When the movie Idiocracy was made something like 20 years ago, which was basically prophecy at this point, the costume director wanted people to wear some ridiculous, stupid wearing shoes and for everyone to be wearing them. And the shoes we're wearing were Crocs. So you're stupid if you wear Crocs, but I'm saying that is kind of an amazing little factoid there that Idiocracy basically ever looks like Shoeless Joe has a career. Hold on, guys. My software is not cooperating again. So my software again, this is a frequent occurrence for some reason. But yeah, Michael, there are too many fintech startups and too many fintech companies to pick a winner. There are many tech startups to pick a winner, and I'm not picking a winner when I'm investing in a fintech company. I'm picking one of many winners. The addressable market for fintechs is absolutely huge because of the section it has with the financial institutions that they're already engaged in. Almost everyone, something like 70% of multiple different banks, and this isn't entirely normal almost in space. You aren't necessarily looking for that one winner that dominates everyone else. What you're looking at is the folks who are able to grab the most in a scramble for clients and products in that fintech space. SoFi is not going to be the only winner by far. I think they're going to face some serious challenges from Apple as Apple gets deeper and deeper into the financial space. And eventually, I think that they are going to face some real competition from Apple. But we're going to have to see how that shakes out and what exactly Apple targets. But it seems like target market fintech app they have would be exactly the market SoFi has now, which is those clients with really high incomes, $160,000, which is 740 something in north. So they're going to be the biggest challenge when it comes to SoFi in the future. But yeah. So Shoeless Joe says, let me see here. Shoeless Joe says, I work for a small tech company that is in the middle of big changes. To our surprise, we're finding some success in Brazil. They seem like a forward-looking, tech-hungry population. Yeah, they're a forward-looking, tech-hungry population because their banking industry is absolutely antiquated and looks a lot like the United States did 20 to 25 years ago. Most things are still done on paper, and for most things, you still have to go into the bank. And that is all changing, and it's changing very, very rapidly in Brazil. And I think that just like the telecoms telecoms that are native to South American countries and telecoms from outside of South America were far more successful than state-owned telephone companies in terms of transitioning into the age of cell phones. I think that some of the legacy banks in Brazil, Argentina in particular, are absolutely going to get destroyed by these smaller fintech companies. They're going to eat into their market share rather rapidly. I think there's actually a huge opportunity for Argentina to do good business. So let me see here. says stocks for the next. That's always what. Man, I absolutely hate Chipotle. I cannot stand Chipotle. When I have the option of going to some of the most amazing family-run mom and pop taco shops all over, I mean, on every street corner here where I live, why would I ever go to a Chipotle Mexican grill? But I'll tell you what, Chipotle is absolutely packed every time I drive by one. I've had it a couple of times. It's not my cup of tea. It's not authentically it's not authentically Mexican, at least to the Southern California taste. Maybe it is. I've had it at a couple of different locations. The good thing about Chipotle is that it's a brand. You walk in, you know exactly what you're getting before you walk out, and the wait times, they look like they're being addressed right now. They're test marking a couple of different strategies, including a double-sided grill to speed up production at peak times. I think you may be right that Chipotle Mexican Grill might be a great stock. I think that we've missed the boat on, of course, their explosive growth, but they may be a good a good linear growth stock, meaning you can count on them making 10, 12% a year for the next 30 years. Not a recommendation to go out and buy Chipotle stock, guys, or sell Chipotle stock or hold it or anything like that. You have to go out and do your own research on this. But look, it's not my cup of tea in terms of a personal dining experience, which prevented me from investing in them early on. I didn't see the possibilities in there. I didn't realize that so many people had poor taste in Mexican food. But I do see now that their business model is absolutely stellar. I do see now what the appeal is to a certain demographic of folks. And I do see that their operational efficiencies look to be improved as well. So speaking of operational efficiencies, back to Sofi just for a moment. So real improvements here don't have to do with the extra $20 million in revenues that they earned. It has to do with their increasing margins on their lending products and financial services products. They are increasing their margins and improving their efficiencies across the board. And that is responsible for the vast improvement in the amount of loss they're taking per share. They've gone essentially, they essentially had 5 cents in loss per share this quarter when consensus was about 8%. So they beat by 3 cents per share. I had them coming in actually better than 5 cents per share. And I was wrong on those estimates. And I didn't have them coming in profitable. I had them taking a very, very slight loss. They are north of that in terms of loss in my estimation. Beat the pants off of consensus. It has to be pretty good for the market. But the market, like Martin says, never been too Chipotle, but it's going higher. Simple menus and easy to make. Yeah, and like I said, like I mentioned a couple of times on my live stream before, I sometimes let my personal biases against a company get in the way of me investing in that company. And the one where I missed the boat on this numerous times. I mean, I hold it now, but I missed a lot of the really large exponential gains in this because I did not believe in their product, because I kept comparing them to top of the line competitor products where they weren't necessarily superior, but they had better marketing. Chipotle also has better branding and better marketing than your mom and pop taco shop, even though I think it has an inferior product. It is absolutely going to beat the pants off of any other quick serve Mexican place that's out there, in my opinion. The future of investing in restaurants, guys, is the quick serve market. And I cannot stress this enough. I know tons in restaurant business. Tons of people in the restaurants, and most of them that are making investments right now are investing in the quick serve model with fewer seats, more dependence on walkaway customers and delivery. This just seems to be the wave of the future, particularly when it comes to carry out. That tends to be the future. People are not buying into the dining in experience as much, particularly when it comes to the quick left food. So So anyway, that is the sort of quick update that I wanted to do today on SoFi. Perfectly willing to take questions if you guys have questions today. Otherwise, I got to get back to doing my hangover in terms of taxes here. I've got a lot to do on that. I'm working on taxes for like 3 of the companies that I'm involved with right now, and it's been rather difficult this year. A lot of challenges, but anyway, folks, don't seem to be having any more questions. I will be back on Thursday in all likelihood, and I'll put out a follow-up video on SoFi. So let me see here. Sheila Joe says, makes sense with the induction of Just Eat, Uber Eats, etc. Yeah, it doesn't make sense to me in a lot of ways. One of the restaurants that I'm a part owner in, we have a sandwich that we sell there with fries. It's like $14, but when it gets sent out by Uber Eats or DoorDash or Postmates or whatever, it comes out to almost $25 per sandwich once delivery fees and all the other fees that these companies are put on there go through. And yet we have a customer that gets 4 of these sandwiches a week, so he's spending $100 on 4 sandwiches a week, and this customer does it religiously. And it's essentially within walking distance of the restaurant. He could walk there and save all of that money. Now the restaurant's not getting a lot of that additional $10 in cost on top of the $14 you charge of the restaurant. Most of that goes to various fees and to the app. But they're still doing this. There just seems to be a change in dining behavior. Whether or not that change in dining behavior survives the recession, which may be coming, and I do think it's going to be a rather shallow recession that we're going to see. Whether or not that behavior survives that change is yet to be seen. So, oh wow, yeah, this is a very interesting thing. So I've been working on my next NVIDIA video, and I just trashed what I just had because so much has changed since then, and we're looking at their focus really changing. So one of the things that I have not been happy with when it comes to NVIDIA that a lot of people have not really taken a notice of is the amount of focus that NVIDIA put on here completely. Now the CEO is really concentrated on the AI world. So with Jensen Huang basically dumping the Omniverse and not talking about it anymore, I need to figure out kind of where the focus is in terms of their investment dollars is going. It seems to be obvious right now that it's AI. It seems to be obvious that that NVIDIA is a great bet for the AI revolution. And I think it's a better bet than almost any individual AI company, largely because they're going to be providing the backbone of that AI company anyway. It's basically like, instead of investing in the gold rush, why don't you invest in Levi's and sell jeans to everyone, or invest in picks and shovels rather than invest in gold mines. Anyway, so I'll be that way pretty soon, or I'll be looking at them pretty soon. So SoFi still believes itself to be profitable. Any chance of being taken over by big bank? I think there's essentially zero chance that Slide is going to be taken over by a big bank. They have a pathway in mind in terms of how they want to do business. They are really adequately well capitalized at this point. They have an improving cash position. Their bank deposit position looks really good. I think it would take one heck of an offer for them to take it to the board of directors, and one heck of an offer to put it to shareholders. So yeah, let me see here. Michael Will says Google's head of AI has quit today and given warnings. Interesting. So I've been less impressed by AI than a lot of people for different reasons. Number one, it's given me wrong answers in terms of tax questions. And I've been able to prompt it to continue to give me wrong answers. And that's one of the things that kind of amazed me, is that if the AI, at least with ChatGPT and a couple of other models, if it doesn't know what the answer is definitively, it'll make up one based on what it thinks it knows from access to whatever materials that it has. And in terms of these like really specific tax questions, in fact, one of them was asked on one of my videos when it came to the S Corp election, and it was absolutely incorrect. And I posted a in the comments. I ended up posting a correction to that, but I'm not sure the person who ever posted the original comment just actually read that. But ChatGPT actually gave that guy an incorrect answer. I think that we're quite a bit away from the time when these companies are really firmly monetizable. The exception may actually be the sort of image generating AIs. I think that some of those companies are going to show fairly solid, fairly solid revenue numbers by the end of the year. Anyway, folks, I got to go. I just wanted to do a short live stream today on Sofi. Like I said, everything looks really good in terms of the results. The resulting crash in the price really had to do with the weak guidance they gave going forward. They didn't reduce their guidance. In fact, they increased it. I just don't think they increased their guidance enough to meet market expectations. I think they're being relatively conservative. I do think that the company will likely be profitable by the end of the year. What's a worst case scenario should SoFi be successful without Galileo? Well, SoFi is already marching towards success without Galileo, which success means profitability, right? That is the goal of every company. But success in the minds of investors means, does it meet expectations? I think that without Galileo and Technisys being a large part of revenues going forward, meaning they're making up about a third of revenues going forward, I don't think that SoFi is going to meet investor expectations in terms of its return. And and I have numbers in mind for when I would consider liquidating the substantial stake that I have, which is not substantial because the price is so low, but I'm hoping that it's going to be substantial by the time it reaches my target price. Which, guys, if you don't know, I never talk about target prices in live streams or on my videos. I think it's a bit unethical to a degree. So so I have been waiting for several, for it seems like forever for SoFi to go up. It absolutely got beat up last year, but it's really approaching the point right now where it's getting closer and closer to being having a fair market value. And this is not a target, but I would not be surprised that if by January of next year, that SoFi is worth somewhere between $9 and $12 a share. That would not be a surprise to me. And that's really just based on fair market valuation, based on where I think earnings will be by that time period. All right, guys, I have to take off now. Thank you very much for attending today. I will be back on Thursday.